All right, getting started. Hello, I'm Mitch Goldberg. Welcome to my live stream. It's called Be the Boss of Your Money. It's about taking control of your money. It's about understanding what's happening in the economic, financial, stock market, housing environments. It's about helping you make smart money decisions that could impact you over the long term. I really want you to be better off after you watch my show. And I want you to keep coming back to watch this show because I do pour my heart out into it. And if I'm providing you value, well, that's a really great thing and it would make me feel good. While you're watching, if you don't mind giving us a thumbs up, a heart, an applause, celebrate whatever reaction is available to you on whichever social media platform that you're watching me on right now. We stream to Facebook and YouTube and Twitter and LinkedIn. And I appreciate so much all of you for taking the time to join me. Plus, when you do give us a like or a reaction, I get to see you as well. Other than that, I don't get to see you. And if you have any questions, you know what to do. Hit me up in the comments or, words of wisdom. You just want to say hi, words of encouragement, good stories. Those are also great to see in the comments. And I live for this. I love to see you in the comments and hearing from you and answering your questions, especially is the best part of doing this. So a couple of things here are millennials and zillennials, well, Gen Z especially, are they right to be thinking that that passing on little things like a cup of coffee will have a very big impact on them down the road financially? Um, there's a survey that says 53% of them believe that is true. And it's really hard to argue with anybody who wants to sacrifice a couple of bucks on a splurge today because they want to save up and invest for the long term. What else? Tesla, Netflix. Tesla's earnings were just out. Netflix's earnings came out yesterday. Both stocks up. What does this mean? Well, it's really all about the expectations game on Wall Street. It's played every quarter. Low expectations are more important than decent fundamentals, at least in the short term. So we're going to take a look to see what's going on. And should you actually buy those stocks? And now that they've beaten their low expectations, maybe they're on their way to a new growth trajectory, right? So we have to talk about that. I will take a look at some general stuff like the markets we always look at as well. Keith, good to see you, my friend. Thank you for joining me. I really appreciate that. We have to do a collab over the very near term. All right. I've been talking about it. I want to do it. All right. So I will see you soon. Enjoy the rest of the show. I'm going to put the banner on and I'm going to run the intro real quick and then we're going to get started. It's going to be a really interesting show. I'm so excited today. Here we go. Keith says yes, by the way. Yes. Yes. Got to do the emoji with the hands up. Yes. Okay. So, a couple of things to talk about. So, let's just take it to this big board over here. Okay. Aftermarket trading, Netflix is down $1, but during the regular session, you could see that it was up 14, almost $15, up 7%. Now, keep in mind, Netflix is, from what I understand, the one of the absolute, if not the worst performing stock in the S&P 500 year to date, from 700 down to 162 at its low, so it's bounced to 215. Hey, 162 to 215 is a great return, especially in a pretty short amount of time. And anyone will say, well, wouldn't you want to buy them at the lows and trade them up? What a simple strategy. Yeah, but from 700, then the low was 600, then it was 500, then it was 400. And at 400, investors are saying, oh, this is a low, it can't go any lower. And then went from 400 to 200, gets cut in half. And then investors say, it can't do any worse. And it did a lot worse. The thought that you are just going to always be able to buy the low or very near the low is, well, there is a way to do it. But the thought that you're going to have this grand slam Sunday punch return is kind of silly. How do you buy the low? Well, if you like an investment, whether if it's an index fund or an individual stock. By the way, you can't invest directly into an index fund, but you could invest in a security that tracks or mimics an index. But if you're going to do that, then you could, let's say, dollar cost average and buy a little bit every month or every quarter, and eventually you'll wind up hitting a low in a really bad market, and eventually you'll wind up hitting a high in a really high market. And that's one way to maybe moderate your purchases and smooth out the ride over time. That's one way. I don't know if that's really what investors are thinking about when they say, "Oh, you could have bought Netflix at the low. It was so obvious," and ride it up to here after the earnings report. First of all, investors were very negative going into the earnings report. The expectations were incredibly low. That's why the stock went up, because the earnings and their subscriber numbers were horrible, but they just weren't as horrible as investors expected. So the stock was able to rally. Some of the short sellers decided to cover. Some investors thought, well, maybe it is too low. Maybe I'll buy some back that I sold. Maybe there were some that initiated a new, uh, a new position. But keep in mind that this was a pandemic stock. It was one of those stocks that allowed us to work from home, play at home, stay at home, because you had nothing to do during the pandemic but look at screens. Those days are clearly over. And unless we get a repeat of that, I don't see how Netflix goes back up. And the competition in streaming is pretty ginormous. Okay, it's just such a cutthroat business. And from what I could see from the numbers of other companies, consumers are generally decreasing the subscription services that they have. Maybe they'll keep just Disney or just Netflix or just Hulu, whatever, but people are getting rid of this stuff, not adding more to the stuff. So I don't think this is really a growth industry anymore. So even if the numbers weren't as sucky as expected, I'm not buying it. Okay. I'm not buying that argument. I'm not giving you a recommendation on the stock or not. When I say I'm not buying it, because I know my compliance people are watching, I don't mean that. I'm just not buying the argument that there's a growth industry left overall in streaming services. Okay. Tesla just announced numbers after the close, and this is what you need to know. Actually, I'm shocked right now. Okay, this is something that I'm shocked about. Okay, you see how Tesla is up $1.50, just $1.50 in aftermarket trading. When I put this board up, okay, the screen, it was up about $15 a share, and that was maybe 15 minutes ago. So what the hell happened? It was up like a little over 2%. By the way, 2% when it was up like $15 a share a little while ago, $17 a share, whatever. It was up like 2%. Let's say $15. That's like 10 cents on a $5 stock. I mean, it's let's not get carried away, because you say, oh, it's $15. Yeah, but it's a $740 stock. All right. Don't just look at the dollar amounts. Percentages are a much bigger deal. So now, Tesla, it's bouncing around a little bit, but it's up about 0.25%, 0.27% right now. Okay. So just beware that, it's a tale of low expectations, but the stock came in. Investors had already bid the stock up about $6 today. And here we are with the stock barely up. This is why I don't like to, quote unquote, play stocks, play the stock going into earnings. I would rather pay up for a stock after good earnings with the confidence that the future is a little bit brighter and it has validated my decision to own the stock long term, as opposed to just try to game it over, a 24-hour or less period. Okay. So, and I just want to tell you something. I kind of screwed up in my answer to a friend of mine over the weekend. Yeah, I was out on Sunday, and we were talking and just hanging out with friends. And one of my friends asked me, "Do you think I should buy Tesla before the earnings?" And my answer is typically something like this. It goes like this. And this is, I wish I'd said this. I said, if your goal is to own Tesla, then you should buy the stock, earnings or not. is that your goal to be a Tesla shareholder, um, then own the stock. And if that's your goal, I could see why some people, have Tesla cars. These friends have Teslas, more than one, and they love the product, and the product is incredible. The cars, so you want to own the stock. It's part of like the whole lifestyle of being in the Tesla sphere, right? But why else would you want to buy it? Well, to make money. That's a different story. If you're buying the stock, why do you think it'll make you money? Because your earnings will be good. Well, they could be good today, and the stock could still go down. They could be bad today, and the stock could still go up. So let's talk about this, because now we're talking about a different thing here. If you put money into the stock, is it money that you're willing to leave in the stock for the next couple of years, long term? Or is this really like you want to put the money in and take it out for another opportunity? Because now you're talking short-term trading. So which one is it? Okay, long-term, that's a different story. What gives you confidence to think that the stock is going to go back up? Is it the cars? Is it the lack of competition, or the competition can't get their sales going with electrified vehicles like Tesla? Like, what is the reason? It's Tesla was an early leader, but the rest of the industry is catching up quickly. So I'm just trying to figure out what's happening. Now, the electrified car industry is going to be a growth industry. So everybody should be selling more cars down the road. But if you look at the companies like stocks like Ford and GM, it doesn't seem to matter that much. Obviously, Tesla's down almost 50% from its high. So it's not just a matter of should you own the stock or not. It's why can you afford to? Are you not just affordability? It's owning a stock is not just affordability. It's a matter of, and it's not just a matter of risk taking. It's a matter of risk tolerance. Look, there are very wealthy people who don't have a lot of risk tolerance, so they don't want to take a lot of risk in the market. And there are a lot of people with not a lot of money to their name, and they're comfortable taking risk in the stock market. Risk tolerance and the ability to take risk are really two very, very different things. And I think once people understand that, they become a better investor. Okay, so let's go on. Okay, 53. Let me make this a little bit smaller so it'll fit in the screen. Okay, 53%. 53% of Gen Z believes small daily purchases have long-term effects on their financial security, a study says. And who did the study? It was Northwestern Mutual. Northwestern Mutual surveyed adults ages 18 and up to determine their feelings about their finances. Okay. I don't know if they only went like 18 to 24 years old or 18 and up and 18 to 50-year-olds, but the percentage of Zillennials, they separated them and said 53% of those people are concerned about small purchases having a big impact on them. Okay. And it went on about are they right or not? And to me, it's here's how I explain the utility of cutting out these small purchases. First of all, logically speaking, if you're going to spend money on a large iced coffee from Dunkin', which is like my preferred drink of choice, I'm on Long Island. As I'm doing this, it's 95 degrees out, so it's hot as blazes. So this is really good. Although I have to say, my office is so freaking cold from the air conditioning, you could hang meat in here, which is probably why I have a sore throat all the time. But anyway, it's a matter of discipline. And what I mean by that is if you have to do everything right, like if you are the type of person, if you are very frugal and you're not going to get the Starbucks coffee, you're not going to get the new updated iPhone, and you're not going to you're going to shop at stores that are less expensive, maybe buy clothes secondhand, whatever you do for anyone, let alone a young person, to spend money, and you feel that the one time you're going to splurge on a $4 cup of iced coffee or a latte or something, if you feel that will throw you off and then you're just going to binge after that because you lose all your discipline, then in that case, if you feel you're going to lose all of your discipline, if you have one splurge and you're just going to binge, then I would say you need to keep everything super frugal. That's what I mean. So it's not a matter of like, well, I never spend money in these things. It's just, can you maintain the discipline? And if you get off track, like if you fall off the wagon on that, will you be able to get back on? Will you take one bite of the cheesecake? Are you going to stop at a bite, at a slice? Would you just go for the whole cake and eat the whole thing? And that's what it really comes down to. But everything that I can tell you in my life, I'm 55, so I've lived a couple of years, right? And I expect to be around for a long time. I'm taking care of myself. But if you're like that, uh, you know, not enough fun in your life, not enough personal satisfaction, that causes problems also. Have you ever met anybody who's really, really cheap? I don't mean just frugal, but a total cheapskate, like someone who's so cheap to the point that they're truly inconsiderate to the people they love and the people they like and the people around them. So disgustingly cheap. Have you ever met someone like that? I have met people like that. And they're not pleasant to be around. And it gets to the point where they're so cheap that it becomes a factor of like a multiplied super factor of becoming an inconsiderate, unlovable person. That's no good. You need to enjoy yourself. Now, how much you enjoy yourself, whether if it's experiences or buying things or not spending money to do things, and not everything costs money, okay? We've got wonderful things outdoors we could do, ride our bikes and hiking and all that stuff, and the beach. Actually, beach parking does cost money, but okay, I digress. But you just have to really know yourself, okay? And you know if you're overdoing it on the splurges or not. Because if you're splurging too much, you probably have a little guilt trip on it. If you don't splurge enough, you might not be happy because you're missing out on something. So you've got to find the right tune. It's kind of like eating healthy instead of dieting, or investing consistently instead of gambling. I hope that makes sense. I'm kind of beating that one up a little too much. Okay. So let's go to the next board, okay? S&P 500 trigger signal with perfect track record for calling end of bear markets. This is written by Jeff Cox, who's a phenomenal and longtime CNBC reporter. I know him, and I can tell you he is terrific. By the way, Stacy, I see you out there. Thank you so much. So this has to do with this, okay? From the tweet of Jason Gopfert, okay? Follow him if you'd like. The bear market is over. In modern markets, the S&P 500 has never lost ground over the following year when advancing volume was 87% or more of total volume for 2 out of 3 days, coming off a 52-week low. And he gives a track record here of about 13 or 14 times. Now, before you say, wow, that's an amazing thing, even he says this is not a perfect track record. The sample size of 13 or 14 or 15 episodes is really a small sample size. Give me, 1,000 sample sizes and we'll be able to get a fuller picture. But it's not big enough to really rely on. And even he says, okay, of course, he attaches two big caveats. On the first point, he notes, of course, this doesn't preclude short-term losses. I can't predict the future. Of course, this time is different. Of course, it would be great to have a larger sample size, which we just spoke about. And beware anything that seems perfect. Well, this does seem perfect as an indicator. By the way, the negative yield curve has been a perfect indicator of a recession coming, which we'll talk about in a moment. But again, that sample size is also not particularly large either. So we like to look at these indicators, these statistics, because it helps give us a sense of control. But the real knock is we control a lot less in life than we think. Okay. So take everything with a grain of salt. And the fact is, if you're a long term investor and you're buying, for the very long term, 10 years or more away, all of this is meaningless anyway. Okay. So just to give you that, let's take a look at one couple of things. Just bear with me. I'm changing my screen right now. Just a second. Stay with me. Stay with me. Here we go. Making it bigger. So you're going to make it a little bigger so you can see it. All right. Here we go. All right. Major averages. So the Dow was up. I forget how much it was up. It was up a lot more than this. Earlier in the day, it was up over 100. And after yesterday's big rally, that's pretty good. The fact that the major averages are up today, by the way, after the big rally yesterday, is actually a very bullish sign to me that there's some follow through. Okay. But the Dow up about 50. It was down about 100 right before the close, and it just popped up 150 points to be up almost 50 on the day. NASDAQ up 184, solid day, and an okay day for the S&P 500. The stuff that's working, by the way, is the high beta stocks or the lower quality stocks, like the pandemic stocks that got absolutely crushed, including Netflix that we went over before. Those are the stocks that basically led the way higher today. But that you have to be into these kinds of stocks in the first place. You have to know what kind of investor you are. This is one reason why I avoid specific stock picking on this live stream, because different investors are interested in different aspects of investing. And I think when it comes to those things, I prefer to play more, I prefer to play financial advisor, which I am, and, market psychologist and client psychologist, and help you pick a direction, pick out what's right for you in terms of stocks or other kinds of investments or ETFs or index funds, whatever, and help you come up with a strategy that's personalized for you. That to me is a much better way to go than just to say, yeah, you could buy this, you could buy that. I mean, I don't know who I'm, I just don't like that overly generic advice. Okay. So gold was off. Well, gold is under 1,700. We've been talking about gold for so long. Could never break that 2,000 barrier. It was, trading between 1,800 and 2,000. I said it was never looked strong, though. We talked about that, right? You heard it right here, down to the 1,600s. We said, gold is weird. If there's real inflation and sticky inflation, why isn't gold going higher? And I've said before that maybe gold is really telling us that this whole inflation thing is not going to stick around for a long time, or at least gold bugs didn't think it would. And we already see moderating inflation. We've talked about that. I'm not going to get into it today, but look at my posts of my 1 minute, 2 minute snippets from the last few weeks. I talked about inflation just, and endlessly. So I don't want to get into it again. Okay. But it's all on my timelines. You can go check it out. Okay. If you want me to direct you to that, just hit me with a DM and I'll send you to the exact spot. Jesse, hi, Dad. I love you. Keep being my hero. Of course, sweetie girl. And Alex says, interesting. Hey, man. Thank you very much, Alex. I really appreciate that. And that's a nice compliment. The 10-year yield up over 3%. It's been there for I guess, a day or two. And oil is off a little, 102. It was down to like 96. It popped a little bit, but nothing major. And let's take it to the VIX. The VIX is below 25. See, this is getting bullish. Well, what I've been saying is about inflation. I'll just say this, that as investors are anticipating inflation moderating, that we've passed peak inflation, stock market's getting a lift. Investors are putting money back in the market. That's what it says. That the Fed is actually getting inflation, that they'll get it under control by tamping down demand hurting the economy. And then you think, but isn't that bad for stocks? No, actually, stocks are a function of interest rates and inflation just as much as they're an indication of the economy. In fact, I think interest rates and inflation are more important than the economy when it comes to the stock market. But the VIX, anyway, is below 25. I've been saying if we could see below 25, that's another knock up for the market. We see that go below 20. I think it would be indisputable that we've got a a lasting rally on our hands, not just what's gotten us up to this point. All right. Let's take a look at bonds, and I think after that we're going to be done. All right, pop myself up here. Let's take a look at the bonds. So short-term yields, 3 years and under, were off a little. Longer-term yields, like the 10-year, were up a little. 30 was off a little, whatever. But the important things are the 10 years 3.02, and the 2 years 3.2. So there's still about a 20, almost exactly. Wow, this is exact. 3.227 minus 3.027 is exactly 20 basis points between the 10-year and the 2-year. That is amazing. Exactly 20 basis points. So the spread between the 2-year and the negative spread is still there. It's still big, and it's, I think the yield curve has been inverted long enough to make it a workable prediction that says we're heading into a recession. What happens is when the yield curve is inverted, meaning when short-term yields go above long-term yields, it means banks don't find it as compelling to extend credit to lend money, and that slows the economy down. And that in itself could cause a recession, and that's how I read the yield curve. It's just a lack of confidence by lenders to give money to borrowers, to lend money to borrowers. And that's the ball of wax. I hope you enjoyed the show. Again, if you have any questions that you wanted to ask me, hit me up in the comments, even when the show is over. I'll see those. If you're watching the replay, same goes for you. And again, remember, a thumbs up, a heart, applause, whatever the reaction is, and whatever social media platform you're watching on is always appreciated, because the sponsor of the show is me. I put my own time, my own money into the show just for you, so I can impart to you my wisdom. I hope it helps you out, and I'll speak with you soon. All right? I'll see you tomorrow.